We're saying it's decision time. It's decision time on elections, particularly the U.S. election, and it's decision time for the Fed. We think that the Fed is going to cut twice this year, starting in September, and that leaves it decision time for clients who have to start thinking maybe it's time to move some cash into fixed income, into equities as those rates come down.
Interesting. Okay, so September start and 2 cuts, even though the dot plots are suggesting more like December and 1 cut if we're lucky. Why are you at September and 2?
Well, first, if you look at the CPI, it's actually started to behave now. Secondly, some of the employment data is suggesting maybe there's some weakness in jobs. And I think if you listen to Powell, he's left that room to be data dependent. So I think the markets are, any given day, it's between 1 and 2 cuts.
Okay. The elephant in the room, right? And I think you're probably going to get a lot of questions from folks here about it. November, the elections. We've got, I think, the first debate coming up in less than a week, next Thursday, right? And the market is likely to start discounting an outcome in November. What are you telling folks about that? Because folks out here in Asia are worried about the possibility of Trump 2.0, right? 60% tariffs or higher on China, et cetera. Although, if you take a step back and look at it more sort of objectively, at least on the surface, if it is Trump 2.0, deregulation, good for energy, good for oil, good for financials as well. But let's leave the tariffs for a little bit later. What do you tell folks when they ask you about the possibility of Trump 2.0?
All right, well, I'm thrilled you asked me this because you're right. We could talk all day about the elections, and even just this debate is going to be probably one of the most anticipated presidential debates in history. Going back to Nixon, Kennedy. So let's try to break this whole topic up into a few things. I think number one is it's absolutely clear volatility is going to rise as we get closer to the election. If you think about an election that could be really close, come down to a few counties, they may just recount those counties, so we might not even know who's the president the day after. And of course, that could contribute volatility. So I think one of the things that we're telling our clients to look at is gold, which we think has a lot of things speaking for it in terms of what's going on in the rest of the world, but it can also be a hedge against some of that volatility.
So is there more headroom for gold? Because it has stormed ahead. It's not that long ago. We hit 24.49 or so, and a lot of that's been driven by a heck of a lot of central bank buying. Is that going to continue?
We think it is going to continue. The central bank buying will continue. A lot of countries have looked, particularly since the Ukraine conflict, is there a way to diversify away from the U.S. dollar? That's something they need to think more about. And we think that, and then if rates come down, the cost of holding gold is not as expensive. So we could see even 2,700 on gold, we think.
Is that right? Okay, so get your gold lined up and in order, all right. But linked to the possibility of Trump 2.0 and those higher tariffs, it likely could mean inflation stays stickier for longer, could even potentially go higher, right? In terms of fixed income and also equities, what do you do in a situation where rates stay high for longer?
Yeah, now maybe we take a step back and saying it's probably still a little too early to panic about election. And again, we have to say that people should vote at the ballot box, not with their portfolios.
Okay.
Really, when you look through history, we do see people tending to get really depressed when their candidates don't win, or too happy when their candidate does. And so you've got to
invest that way.
You should not invest that way.
Okay.
That said, I think if we take the Trump sweep scenario, I think there's some things that are going to happen. It should be great for bank stocks. It should be good for some of the commodity stocks. Probably less good for consumer staples, and also maybe some of the renewable energy stocks. Although there again, as President Biden says, so much of the investment has gone into these red states. It's really a question, how much a Republican administration would really unwind at the end of the day.